Okay, we're now broadcasting. Good afternoon, everyone. I got a couple minutes to 12:30 before we kick things off. Hope everyone's having a great day. I know I'm certainly excited, counting down to the kickoff of the NFL this after 8:30 tonight. So it should be a good one. We'll just hold off a couple more minutes and see who else is joining us in the meantime. All right, now people are rolling in. Right on time. Fantastic. All right, and my watch is saying exactly 12:30, so we'll get things kicked off. This is a pretty full topic, a pretty large lift here, so want to get started and may run a minute or two over, so I apologize ahead of time. Thank you for joining me. Again, another beautiful day here in Rochester, always sunny blue skies. I'm glad that you could join me for another round of the Tele, what you need to know about your 401k right now. So ground rules should feel a little familiar. Targeting about 15 minutes, try and make it a valuable use of your time. Always happy to take questions. Really excited. This week's topic was submitted by a couple different people. I want to use the term fans, but I feel like that might be a little bit of a liberal interpretation by the audience. Submitted these. So if you have any questions or if you have other topics of things you think would be valuable to cover, please reach out. I'll address all the questions at the end. And then as always, here's a resource here to help with anything in life with a dollar sign next to it. That's one of the big reasons why you work with Sage Rutty. We're here to help you with any financial questions and concerns. So without further ado, let's talk about what we're going to talk about today. So the big topic, what we're tackling today is paying down debt versus investing. If I had extra money, should I be putting it down on my car loan, or should I be putting it in the market, or should I tackle my mortgage? Should I tackle credit card debt? What makes sense? So I want to start. There's a couple of prerequisites that go along with that, things that you got to make sure before we even start the debt versus invest conversation. Always make sure this is tackled. Then we'll talk about the two sides of the battle there. And then if it does make sense for you to be tackling debt, what's the most efficient way to do it? And as always, how do we put that into action? So priority number one, not to beat a dead horse, you need to have an emergency fund before you consider paying down debt, or before you consider investing into the market. You need to make sure that you have an emergency fund, right? 3 to 6 months. And I want to stress that this is not an investment, right? This is not, I'm going to put in 3 months worth of rent into the market, and then if something happens, it's there. No, it needs to be liquid. It needs to be in a money market or a bank account, something fully liquid. And it's not an investment, it's insurance, right? It's insurance against really bad stuff happening to you. So can't stress it enough, have an emergency fund. Priority number two is, as you're taking on debt, make sure that your lifestyle lines up with that, right? You don't want to be tackling credit cards at the same time as adding a lot more onto the credit cards, right? Make sure that you're living the lifestyle. I love this picture, right, of you're bailing out your boat while there's still holes in it. You need to fix the holes before you target trying to solve the debt problem. So especially true if it's credit cards, a little different if it's like student loans or mortgage. That's definitely a different area. Cars are kind of a middle ground, but make sure that you're aligning your lifestyle sustainably before you start investing or paying down debt. So those are my two public service announcements to kick us off. But let's really dive into does it make sense to pay down debt? Does it make sense to invest? right? If I was sitting here with an extra $5,000, where should I be going with it? So I'll start with talking about the argument towards paying down debt first. So there's a few areas that come along with that. The first is that debt is a burden. Second, it talks about the returns, cash flow, and then we'll talk a little bit about retirement income. I recognize that I'm a little biased to think about retirement every day, but there is an argument to be made in favor of paying down debt that directly relates to retirement income. So to start, a little on the psychology of things, that debt is a burden as much as it is just the interest that you're paying, right? There's more involved than just, okay, I'm paying 3% interest. It's also in the back of your mind recognizing I owe someone else money, right? Someone else needs to receive something from me. This especially comes into play when you're dealing with a family member. I know that when I first graduated college, I owed a little bit of money to my parents, and that was priority one, right? I don't care that they're not charging me interest. I don't like the tax on me of knowing that I owe a family member some money. So a really big argument could be made if you're feeling burdened by the debt, maybe starting with debt is the right answer. The second argument is looking at returns. So hypothetically, would you rather have a guaranteed 5% return or an on average 8% return with a potential negative 30 or potential positive 30, right? And in this scenario, a pretty decent argument could be made, maybe paying off the car and getting that guaranteed avoidance of 5% interest might be more favorable than, long-term the market's returning 8 to 10%, but you're dealing with the volatility along the way. So a lot of people appreciate the guarantee of not having to pay that interest, that guaranteed return. The third argument looks at cash flow, right? At freeing up cash flow. So I have some items on here, kind of essential expenses in a normal month, right? So you have your mortgage or rent, then you have like your property taxes, insurance, you have a car payment, a student loan, insurance on the car, you put gas in the car, put food on the table, right? And in this scenario, which probably or hopefully feels somewhat familiar, right? You're looking at, I need to have 2345 coming in even without any discretionary spending, right? I need to have this much coming in no matter what. If you are able to eliminate debt from that drops off 1250 off that number, right? Talk about easing some burden, talk about building up some flexibility. There's a really big movement out there called the FIRE movement, the Financially Independent Retire Early. Eliminating debt is such a huge part of that, because if you need the job to be paying you $2,400 right off the bat just to exist, that's a lot more difficult than really I need $1,100 to be able to exist, and then discretionary spending above that. So there's something to be said by freeing up cash flow can really ease a lot of burden and provide you some flexibility. The fourth and final argument towards paying down debt is the leverage that comes along with that, specifically looking at retirement income. So say that you're paying $700 per month in principal and interest on your house. To be able to generate that amount of income each month from your retirement savings, you need about $210,000, right? Pretty astonishing. You need this much money to be able to generate income of $700 a month. And also that's net of taxes, right? So it's $210,000 if it was sitting in a bank account. It's probably closer to $280,000 if you're drawing it from a 401k. I'd argue that it's a little easier to pay off the mortgage ahead of time than to have that chunk of change in your 401k to be able to sustain that in retirement. So there's definitely a good deal of leverage that comes along with eliminating debt. Now, on the other side of things, for all of my people that are favoring investing first, let's look at the 5 areas that make the most compelling argument in that favor. So first and foremost is leaving money on the table. The rate of return can arguably be larger. Access to the funds is important. There's an argument to be made around taxes while you're working. And then the reality of the invest the rest mindset. So first and foremost, if there's a company match, you would be crazy not to get the free money, right? Say that your employer is offering a dollar for dollar match on the first 3%. For every 1% you put in, you get 100% return on that, right? It'd be crazy to pass it up. Or if your employer is offering you 25 cents on the dollar, it's a 25% guaranteed return before you have any risk, right? You're putting your dollar in, you're immediately getting a 25-cent return. That's awesome. Don't pass up free money. Always make sure you're at least getting all of the free money that's out there. The second argument is just the dollar for dollar rate of return on these, right? Especially when it comes to your mortgage, we're right here, right? We're looking at historically low mortgage rates. I think as my parents have talked about it and clients have talked about it, my first house, I was paying 16% interest on the mortgage, right? It was a lot easier to say I should pay off my mortgage at that point. Nowadays, my mortgage I just got earlier this year was at 3%, right? It's a little harder to argue paying off 3% versus investing that historically has returned, triple that. So long term, especially in really low interest rate environments, the argument can be made, maybe investing is the right spot. If you are looking at different forms of debt, maybe that argument is less compelling. If you're looking at credit card debt and you're paying 17%, pay off the credit card debt, right? And arguing that you're going to out earn that on a regular basis is a little bit crazy. The third is access to the funds. So think about if you're in a pinch, right? And you didn't listen to my advice at the start of this, you don't have an emergency fund, but you need $3,000, right? It's much easier to access an investment account. You can say, okay, I'm going to take from my brokerage account, or I'm going to borrow against my 401k. If I'm in a pinch, I have access to that money if I invested first. If instead I paid off debt first, it's a lot harder to hand your diploma back to the school and say, hey, reissue me another student loan. I need some cash. You take this piece of paper, I'll take the loan again, right? So having access is something that's important and kind of nice that it's out there and ready and available if you are investing first. The fourth benefit there is that there's a benefit if you have access to pre-tax accounts. There's a benefit tax-wise while you're working to invest first. So specifically looking at if you don't max out your 401k already, the argument can be made that you should be maxing out your 401k before paying down the debt, or at least that there's kind of a favor to that. So if we look at these charts, which I've shared several times during the Tele, this is our gross income taxable chart. So say that you fall into the category that you're paying 22% tax bracket right now, right? You're married and you and your spouse bring in $100,000, 22% in federal taxes. But if we look at retirement, you're going to be spending less, right? You don't have the commuting costs. You don't have, you eliminate some of the state taxes that are coming out. You're just cutting down your costs, hopefully have the mortgage paid off, and you're going to be down in the 12% bracket. Well, the argument could be made, instead of paying off my car early, for every $100 that I put into my account, I'm getting an extra 10%, an extra $10 in tax savings there, right? Right off the bat, the numbers start tilting towards investing first when you recognize, hey, there's a tax benefit that comes along with that. So something to keep in mind, especially if you find yourself on the cusp of any of these brackets, right? Of okay, right now I'm doing really well. I'm in the 32. Likely when I retire, I'm going to be in the 20 or 24 or 22 or 12. It makes it a little bit more compelling. The final argument towards investing first is this mindset around invest the rest, right? It's a popular phrase, especially around insurance, and the idea that, okay, if I can cut costs on one side, I'll take all the rest of the money and I'll just invest it. And the reality is that most people, when looking at the situation that we looked at before, right, you were able to slash all of these debts and you freed up $1,250 per month in extra cash flow. Most people look at that and say, yes, I have an extra $1,250 per month coming into my bank account, right? Maybe I'll invest $800 and I'll keep $450 and I'll spend it, and it feels like a good compromise. In dollars and cents, if that's what you're working towards, paying off debt, and you're not going to end up investing the rest of it, it probably favors investing it first. Maybe you do need to be investing it or automating some of that. If when you see extra money come into your bank account, your first thought is spend, your second thought is to save it. So kind of recapping, I think this slide's helpful. I'll give you kind of the side-by-side. It really comes down to what your priority is, right? There are some really compelling things, especially if it's a burden, right, of you're feeling like you're indebted to a family member. Maybe debt first is the answer, or getting a guaranteed return, especially if it's a high return like on a credit card. Maybe debt first is the answer. On the investing side, there's a pretty compelling case to be made on the tax front. Even though Congress eliminated the deductibility on mortgages, well, not eliminated, but capped it to a point that most people in New York can't fully take advantage of it. But from an income tax standpoint, there's still a benefit to the invest first strategy, and has a lot of potential to really grow your wealth quickly by doing the invest first. So it does make sense. So if you do fall on this side of things, I did want to give a quick advice on how to pay off debt quickly, how to tackle debt first. And there's really two main schools of thought out there on the debt pay down strategy. There's the avalanche approach versus the snowball approach. Avalanche is the idea of whatever has the highest interest rate, you pay that first. No matter what, pay the highest interest rate first, and then work your way down the list. The snowball takes the approach of pay the smallest balance first, then the next smallest balance, continue to knock off loans from the smallest balance, moving upwards, regardless of what the interest rates are on them. So here's a list just for example. So if you had an extra $500 per month, what debt do I pay down first? The avalanche would say, start with the Visa one, look at that really high interest rate, put your extra 500 there. Once that's paid off, let's move to Sears because that's a high interest rate. Then let's move to the student loan, right, and continue down the path. The snowball, on the other hand, would say, I have an extra $500. I'm going to pay off the Sears one right away. I'm just going to eliminate that. And what comes along with that is now you no longer have that minimum monthly payment on the Sears, right? So now Sears is paid off. So now we have $550 instead of $500. Let's focus that on the car payment, right? I owe $1,000 left on the car. I'm going to put that $550 towards that until that's paid off. Then both of those are paid off. Now I'm up to $625, right? And it's the reason they call it the snowball. It's growing, right? Each time that you pay off a loan, it continues to grow the extra cash flow available, and you're really building up momentum. So in dollars and cents, the avalanche method works faster. You save yourself more dollars in interest if you go with the avalanche method. Personally, I'm a really big fan of the snowball approach. That's what I've done in my life. I'm debt-free besides the mortgage because I've been able to pay down everything, and I use the snowball. And the reason is that it really builds a lot of momentum on a human side, right? And actual human behavior, doing the debt pay down using the snowball. Kellogg School of Management did a study. People that did the snowball were 14% more likely to eliminate debt after a 1-year period. People that did the snowball were 43% more likely after 4 years, right? Because you're building up. You pay off the small one, great. You feel energized. I'm going to work even harder on the second one and on the third one. It really honestly does work. I can testify to it. It may not save you the most total dollars of if you have pure determination, but I'll tell you that the snowball makes it a lot easier on a human level. So as always, how do we put this into action? How do we take what we learned and immediately apply it? First and foremost, emergency fund and credit card debt. You need to make sure you're having an emergency fund and that you're not adding to your debt while talking about investing or while talking about paying down debt, right? You need to kind of plug the holes in the boat before bailing the boat out. Second is look at what your top priorities are. If you have extra cash on hand, what do you want to accomplish with it? What purpose is that trying to serve? Is the priority easing some of the stress of having debt, or is the priority I'm just trying to maximize my wealth? I want to have the largest pot of money possible. Maybe investing is the answer. Third, look at the practical application. Look at what puts you in the spot to most likely do it. Um, I I share with people all the time the number one reason the 401k works is that it's automated, right? If you want to make sure you're saving, have it happen directly from your paycheck before you ever see it makes it so easy. And the fourth, anyone nearing retirement, debt equals leverage, right? Eliminating debt eliminates a huge need for a pot of money to be able to service that debt, right? $700 a month or $210,000 after tax. It's a pretty massive trade-off. So if you're able to pay off the debt before you retire, saves you a pretty big burden. So I apologize that I'm running a little over on time. I think we're about 4 minutes over. As always, thank you. Thank you for your time. Thank you for the business and trust that you place with me, that you place with all of us at Sage Rutty. We know that there's a lot of options out there, and we appreciate that you continue to choose us for your financial planning needs. If you do have any questions, very much happy to take those questions. I know that sometimes it's easier to do them individually via Zoom call or conference call or email. Always happy to do so. My contact information's on there. Always happy to help. All right. And I always love those questions when it's just a good job. Thank you for the virtual pat on the back. I appreciate it. This was a pretty fun one. I have a guess that maybe this anonymous person was the one that suggested it. So thank you for the topic. Made my life a lot easier trying to think up what to chat about. All right. And if we don't have other questions coming in, I will remind you, if you wanted to watch this again, if you want to share it, if you want just a quick summary page on it to share with somebody, after each of these, we post these on our website and post a one-page summary, gives you the high bullet points. I know a couple people from HR are here. So if you, ideally you want your employees out making money for you, but this is valuable information too, please feel free to forward on the summary page. Makes it a little easier to digest and flexible on the timing of when you can read it. So again, thank you all. I hope you have a wonderful afternoon and take care.